Are you an accountant with a continuing education requirement? You can earn free NASPA-approved CPE for listening to this episode. Just visit earmark.app in your web browser, take a short quiz, and get your certificate.
Hello and welcome to Oh My Fraud, a true crime podcast where the bodies aren't buried in the backyard, they're in the footnotes. I'm Caleb Newquist. How's it going? You're in for a treat today. I am talking to Jonathan Weil of the Wall Street Journal, and that's exciting because I've known John for quite a while. We never worked together directly, but we had like lots and lots of off-the-record conversations over the years, and you'll hear us talk about our history a little bit. But if you're not familiar with John, he currently covers accounting and corporate governance for the Journal, and I first got to know him when he was still at Bloomberg about 10, 11 years ago or so. He was kind of like, Bloomberg is known for having this big, like very deep roster of opinion columnists, like very smart people. But John was one of the opinion columnists like before all that happened. And anyway, he was one of the few people who had an opinion column that covered accounting and auditing in kind of this deep and serious way. And I just remember reading him when I was still working as an accountant in New York in the late 2000s. I had become obsessed with reading like financial blogs, and there just weren't that many people writing about accounting, just not on blogs, but just in the legacy media in general. Like, there's Francine McKenna, who had a blog. That was one of the first people I found, and Greg and I interviewed her way back on episode 7. If you want to check that out. There's this guy, Jim Peterson, who also had a blog. But in the mainstream press, there was Floyd Norris at the New York Times, and there was John at Bloomberg. And I'm probably forgetting other people, and John mentions it in our chat that there were definitely people on the beat, but he was one of the few people doing opinion writing back then. But prior to that, he just did regular old reporting. Anyway, I got to know him, and we, like I said, exchanged notes a lot and had a lot of good conversations and talking shop and stuff. Anyway, it was fun to talk to him, and so yeah, it's going to be a good episode. So anyway, thanks to everyone who's rated or reviewed the show on Apple, Spotify, Earmark, wherever. And, especially on Apple, Zach is still complaining about, that comment that is complaining about the language. So if you can, do him a solid, do him a solid, me a solid. I don't know. Just, somebody write a review on Apple for Zach's sake. Anyway, thanks. One other bit of business. This is the second to last time that I'm going to say this, but Greg and I will be at the New Jersey Society of CPAs Convention and Expo on June 5th in Atlantic City. That is coming up very soon. So if you're in the neighborhood and you'd like to see us give a little presentation, IRL, that's how you can do that. There's a link in the show notes if you want to register for that show. Also, if your convention, firm, business, or organization would like some training or fraud on ethics, let's talk about it. Email ohmyfraud@earmarkcpe.com to get more information on pricing and availability. All right, that's all the business. And I could go on and on about John Weil. He's a great guy. He's a great reporter. And I don't know. We had a good time. So here's me and Jonathan Weil, and I hope you enjoy it. Well, thanks for coming on. I know this probably isn't the Journal's like preferred venue for one of their people, but you made it happen.
know you, Caleb. Thank you for having me.
I know you know me. So yeah, we're going to talk about that. I think the audience will enjoy that bit of it, but we are here to learn about you, John. Where'd you grow up? I don't think I have any idea where you grew up.
Hollywood, Florida. Went to school in Fort Lauderdale.
Okay, cool. How was growing up in Florida? Probably great.
It's warm.
Yeah. What'd your folks do?
My dad's a retired oral surgeon. My mom took care of my brother and me.
All right.
And my dad.
Nice. Yeah. Yeah. Well, yeah. Yeah. Cool. And so in those days, like, did you have any early indications of like what your professional future would be as a kid, or like what were your interests? Did that emerge early?
By the time I was a teenager, I knew I wanted to go to law school and be a lawyer. The journalism bug caught me when I was in high school. My junior year, I got on the school newspaper and had taken a journalism class that we had. And then the senior year, I was an editor of the school newspaper. And the bug stayed with me, and I went to college and got on the campus press at the University of Colorado at Boulder, and was a journalism major, and then dropped the bug for a while and went to law school, but then kicked right back.
So you go to CU. What took you to CU? What was that? Why did that happen?
My parents, they'd always taken us for ski vacations since I was
cool.
a little kid, and I wanted to ski.
Yeah,
it's the only school I applied to.
Oh my gosh!
So
and you got in.
I knew I was going to get in.
Yeah,
I was confident I was going to get in.
Yeah, good. But
good
grades.
I saw lots of friends who were applying to 18 different schools and trying to get early admission here or there, and but I just wanted to go to Boulder, so I went to Boulder. I applied, and they got in, and I think I found out by October that I was in or something.
Oh yeah,
really funny. Early, and so I just had the rest of the senior year to have fun.
Oh, cool. Yeah. As someone who grew up in Nebraska, I have.
You know what the Nebraska's helmet stands for, right?
Knowledge, I believe. Yes.
Did you hear the story about the Nebraska fan who was 4 days late for the game in Boulder?
No, tell me.
He got on the highway and saw the sign that said "Clean restrooms ahead," so he did.
How many of these you got? You got
I could be here all week with this. We had T-shirts made up with all of these jokes too. So
yeah, I grew up in Nebraska.
Growing up in Nebraska, you were saying?
Yeah, no, so I grew up there. So of course, in those days, it was the '80s. So I'm a little bit younger than you, but like I was raised that the only rival that Nebraska had growing up was Oklahoma, and we're talking about football here, obviously, but for those who are not athletically inclined, we're talking about football. And so CU, who we also played every single year, and CU hated Nebraska. It was like one of those things where I just remember CU hated us, but we were just kind of like above it all.
You were indifferent, yeah.
Bill
McCartney chose Nebraska as a rival, and Nebraska wasn't even aware.
Yeah, no, Nebraska wasn't aware.
But then we got good, and suddenly we were beating them, and they...
That's right. It was the late 80s.
There were concerns.
Yeah, it was the late 80s, early 90s, and you all like beat us like 2 out of 3 years or something like that. Like you had this like kind of this kind of
2 years in a row, and then there was a tie. Yeah.
Right, that's right. I remember those games. Yeah. I remember those games, and it was just like, and I remember Nebraska losing, and it was like devastating because
game of the century.
Yeah, it wasn't supposed to happen. And so you were at CU then when they won the national title in '90, right?
Yep.
That must have been great.
It was. I was in the Orange Bowl both years because I grew up down there. It was perfect for
that.
For Christmas
break. Yeah, perfect.
Yeah.
Cool. Yeah, great time to be at CU. It's still a pretty good time to be at CU even today. It's amazing up there.
You get CPE credit for this, right?
Oh yeah, we're getting to the good stuff.
Okay,
everybody be patient. No worries.
I'm not rushing.
Okay, so CU, continuing with the journalism stuff, and then law school, and so the journalism stuff didn't dissuade you from the kind of the early dream of going to law school, becoming a lawyer.
No, I knew if I was ever going to do it, I should do it soon.
Yeah.
And most importantly, I wanted some form of graduate level education.
Yeah. Okay.
And I look at, I wouldn't recommend going to law school unless you actually intend to practice law.
Mm-hmm.
But if you're going to start and get halfway through it and decide you don't want to practice law, you should still finish law school and finish what you started and get your license.
Yeah.
And do it properly, which is that was the scenario I was in. By the second year of law school, I knew this was really interesting, but I didn't want to do insurance defense or something like that for the rest of my life. So, but I was going to finish what I started.
Okay. So in law school, I know, most law, you went to SMU, right?
Yep.
Dallas. Okay. And how'd you like it there?
Loved it.
Yeah. Cool.
Still in touch with the folks there.
Oh, nice. Yeah. Now I know I didn't go to law school. But I do know that virtually every program has an accounting course and of course securities law and stuff like that. Did that kind of stuff was that your first introduction to that kind of stuff? And is that how you kind of got this new bug before graduating?
Well, when I interned for the Journal, when I was in college, I interned for the local papers, the Daily Camera and the Denver Post, and that got me an internship with the Wall Street Journal and the Washington Bureau right after college.
Okay, gotcha.
And that was turning into a job. I graduated college a semester early, so I had an internship for the first half of 1992 with the Journal in D.C., and I was covering economics. So it was a little bit of, the doing stories with dollar signs in them and percentage signs and that type of thing that I really hadn't done very much of when I was in college or high school. So that got me a little bit. But after first year of law school, I decided I didn't want to practice law. That, in my mind, I don't care about grades then anymore. So I'm going to go take all of the hardest possible classes in fields I would have never otherwise thought about taking, just because there's nothing to lose.
Right.
This is a chance to get exposed to things that I normally wouldn't. So I looked at I had never taken that much. I took an accounting class when I was in college, one.
Yeah.
And I just for kicks, I had this idea that I should be able to read city council budgets or, some vague notion like that. But in law school, I took tax, I took corporate tax, I took securities regulation, and I'm still in touch with one of my old professors, Mark Steinberg, who still teaches at SMU. I took a commercial paper. Just every single class that journalists would get, kind of like they drank their cold milk too quickly. You get all the types of subject matter that give a lot of non-Wall Street Journal reporters brain freeze.
Yeah.
And that's what I did for second and third year. I took construction law, just anything that was business and finance oriented that seemed, because it was stuff that I didn't think I had enough exposure to. And so that's but after law school, there was one story in particular. I took an internship just to get my toe wet again at the Dallas Morning News, just for the summer. And I was doing a story about this movie chain called Cinemark. I don't know whatever became of it.
Yep.
But there was a lawsuit going on, and then one party was suing the other party. And then the CEO of Cinemark, which was publicly traded, was taking the position that the CEO had some secret handshake deal over something or another with the other person they were litigating against. And just like the instruction I had just kicked in immediately. I said, well, okay, secret handshake deal, and this sounds like it was really important. Oh, yeah, so where's the 8K? And, the guy on the other end of the phone was like, he said, well, I'll get back to you on that. And there was not an answer.
Right.
And called back later, and he said, well, how did you know to ask that question? I said, Professor Steinberg's class. So I took securities regulation from Mark Steinberg.
Right. And an investigative reporter was born.
Well, yeah, there's it's nice when you can marry the skill sets.
Yeah.
In ways that, when you do that, one thing I, also learned young is I always like to go after stories where, to use the language of business, there's a high barrier to entry.
Mm-hmm.
Because it means you're going to have more time. You're going to have less competition.
Yep.
And chances are you'll be able to really make sure you can do it right. So I always gravitated toward complexity.
Yeah.
And stuff that other people didn't want to, invest the time in. And it's funny, you might remember the name Abraham Brilloff.
Yeah. Baruch guy, right?
Yep. May he rest in peace. May his memory be a blessing. He died about 10 or 12 years ago. He was one of my mentors when I got to New York. Accounting professor emeritus at Baruch. And he explained to me that, you're learning one story at a time, all these different tricks about the way financial statements get prepared and the like. He goes, that's not much different than the way that we teach our accounting students in the case study method, which isn't really much different than the way you learn the law in law school, one case at a time.
Yep.
You read one case, you read one case study at a time. With journalism, it's one story at a time. Every story, and then once you've done enough and you've done enough reps, you get to the point where you've done enough reps that you know the difference between a new trick and something that's not a new trick, and well, this is a new trick. I've never seen this trick before, and you're able to spot that just because of pattern recognition and being able to spot that. Oh, this is actually a new and creative approach to presenting one's facts or numbers.
Yeah, inventory or accounts receivable or whatever it is.
Yeah.
So okay, so law school, you got a couple internships under the belt. I mean, you're already making an impact. Like, you know to ask about 8Ks. So you go, your first job out of school was in Little Rock, right?
Came the Arkansas Democrat Gazette.
Okay.
The Journal wouldn't take me back immediately. They said, "Go cut your teeth all." This is after I graduated law school.
Yep.
Took the internship at the local paper just to get my toe wet again.
Yeah.
And the folks at the Journal were saying, show us you're not some kind of a dilettante. You got to go cut your teeth all over again. And, go somewhere, break some stories and keep in touch. And, let us know if you stay with this business.
Yeah.
But it's a great paper. I just had a great time there and was there for about a couple of years. And then the Journal took me back.
Okay, so you're at the Journal in Texas, and about what year is this?
97.
97. Okay, so at this point, did you know what Enron was?
No. Well,
Okay.
I knew it existed.
Okay.
It was funny. They hired me to do a regional version of Heard on the Street
Okay.
called Heard in Texas,
All
the
right.
stocks column. When I had been the last year I was at the Democrat Gazette, I was a political reporter. Having all sorts of fun with Mike Huckabee's finances.
Oh yeah. Nice.
It was those stories that got me at the Journal. He was the governor at the time.
Yep.
But they hired me to do this regional version of Heard on the Street, and there had been a couple of very good Heard writers who had been doing that before me, and it really shown their ability to find stories that the markets didn't know about. It moved stocks regularly. And when they hired me, I didn't know what a PE ratio was. So
Yeah.
I had to figure it out. But I'd been a reader of the Wall Street Journal when I was a kid, and I'd worked for it before. So, when I talked my way into them hiring me, I remember telling Paul Steiger, who was the managing editor for the paper, I said, well, I think any good reporter should be able to cover any beat. If you're good at covering the school board, you'll probably be good at covering science, probably be good at covering sports. And if you're telling me you want me to write a stocks column, okay, I'll figure it out. That's what we're supposed to do. We're all jacks of all trades in the end.
Yep. And so it's the late 90s. And so by this point, you'd heard of Enron, but it was just this hot, notable company at the time, right? It was on the upswing back then.
Yeah.
Yeah. And huge presence in obviously Houston. And so then so tell us the story about how does all of a sudden the Enron, how does Enron become a story? How did it become a story for you?
Well, I think you're talking about a story I did September 2000.
Okay.
It was the last story I did for Texas Journal. So I'd already been there for a few years. And the .com, just to set the stage some, the .com bust, the peak was March 2000. And there is this, and then it cracked. And by the time we got in the summer, people were looking for new themes. And one of the themes that served as a tailwind for all the energy traders, Enron, Dynegy, El Paso, Duke, Williams, you name it, was, and this is when people, at the Wall Street Journal, it's funny, I was looking back at old stories and saw in one that we used to capitalize the terms new economy and old economy back in the late 90s.
Oh, really? Oh, funny. Yeah.
There were old economy companies, old economy stocks, new economy companies, new economy stocks.
God, that made it into the style guide, huh?
Yeah,
That's
we don't
funny.
do that anymore.
No.
That eventually, had an expiration date on it. But the bull case, to the extent it hadn't existed already on Enron in particular, was that, oh, it's the perfect marriage of the old economy and the new economy.
Oh.
We just had the bust of the dot-coms.
Yeah.
And here, this perfect marriage of the old economy and new economy. They're energy, they're fast, they're pipes, they're gonna trade bandwidth. And so their stocks were rocketing at that time. And so, how the story came about, somebody, summer of 2000, I've never said whom, or never said who, the person's never wanted to be known. Someone in the investment management business, is the way I described him to Malcolm Gladwell, said to me, you really ought to take a look at Enron and Dynegy and see how they make their numbers and see where their earnings come from. And so I did. And it took, at that time, the language to describe what they were doing, the language we have now to describe what they were doing.
Yep.
Things like level 1, level 2, level 3 assets and liabilities. That language didn't exist then.
Right.
People didn't, the term mark to model was not really widely understood, much less, something like mark to make believe.
Yeah. That's right.
To explain, mark to market accounting was not something that people had great awareness of because I don't think even derivatives were being marked to market yet.
Right.
At least not, there wasn't a requirement to, or they hadn't been in effect. Those rules hadn't gone into effect yet. But once you figure, and then there's another, factor that served as a confluence here. The accounting beat position had just come open in New York at the money investing section for the Journal. And I really wanted to do that. And I wanted to come to New York and be the accounting beat reporter for the national paper. And the editor at the time, great guy, Larry Ingrassia, we're still in touch, great friend. And I don't remember if he remembers a story, but he said, "Look, I've read your stories since you've been down in Texas, and you've had a great run on exposing a lot of frauds and starting investigations, but I've never heard of any of these companies. How about you tear apart the books of a company I've heard of before, and then we'll talk about the accounting beat." And I had Enron and Dynegy on the shelf, so that kind of gave me extra motivation.
Yeah.
To start digging on those, and once he could figure out that if you want to talk a little geek speak here, the line on their balance sheet on the current assets, current liabilities, long-term assets, long-term liabilities, risk management activities. That was the name of the asset and the liability. Once you could figure out that all those meant were unrealized losses and unrealized gains.
Yeah.
Oh, and then if you took the net change in those four numbers every quarter, you could tie it back exactly to a single line item on the operating cash flow statement. I didn't figure all this out myself. My friend in the investment management business had, shown me, look, here's the arithmetic. And this is how you can get to the point that these are their unrealized gains. And you can take that as a percentage of any pre-tax number you want. And in their case, the particular quarter that I happened to be writing that, I wrote about it in September. At Dynegy, it was their unrealized gains were some massive percentage of their EBIT, their earnings before interest and taxes.
Yep.
At Enron, they exceeded EBIT. At El Paso, they didn't give you enough numbers to be able to tell. So they actually thought El Paso was probably, the craziest of them all. And the funny thing is you could learn more from reading, you could learn more about Enron's accounting practices and risks. This was true for El Paso too, from reading Dynegy's 10K and 10Q.
Yeah.
Because Dynegy's disclosures and their footnotes, they cautioned about how much volatility there would be in these numbers. That there was all these different risks. They gave detailed time horizons for the duration of the contracts. Could go out 30 years. Enron would give you an average, like 2 years. But then you could but because you knew that Dynegy was doing 25, 30-year contracts, you knew that Enron was doing 25, 30-year contracts. Right. And then, you'd have to confirm that with Enron. You couldn't just look up their filings and see that.
Right.
Dynegy, so, Enron, when they would describe their valuation methods, they would just leave it as management's best estimate. Dynegy had 2 pages explaining all of the all the risks and pitfalls. So anyway, that's how the story came about. The headline the headline on it was Energy Trader Cite Gains, but some math is missing.
Right.
September 20th, 2000, coming up on 25 years since that ran. It had, when that story came out, the stocks got impacted that week. There were sell-side notes coming out trying to debunk the piece.
Yep.
Executives weren't particularly happy about it.
Right, of course.
Enron and Dynegy, the Monday the story ran, both flew up, teams of executives to talk to me that day.
Uh-huh.
I had been asking them questions for a week or two at that point, but they didn't. We were, it wasn't like the Wall Street Journal where you never know when something's going to come out. Our Texas Journal came out on Wednesdays, so we couldn't necessarily head fake them.
Yeah.
It was either coming out soon or not. But once they realized, no, we're actually going through with the story, they flew people up, and it was those were some fun conversations.
I bet. Yeah. Okay. And so then, and the rest is history, kind of, right? I mean, that was kind of. I mean, it's literally in your bio on the journal. That's like you were one of the first, if not the first person, to just start calling attention to this stuff, and that's when things started to unravel. And so then
let me correct you on one thing.
Yeah,
there was
please.
a reporter in 1992 at Forbes. I'm sorry, I don't remember her name offhand. I know she passed away some years ago. When Enron first implemented what we would call mark-to-market accounting, because the SEC gave him permission to, who wrote a short essay for Forbes criticizing this. And if you read Kurt Eichenwald's book, Conspiracy of Fools, he chronicled this exchange of letters back and forth between her and Ken Lay after that came out. As far as I know, neither she nor anyone else until 2000 wrote anything about Enron's mark-to-market accounting.
Oh, wow.
And the funny part is, the first, the language on that site, it was the first to challenge their accounting practices during the dot-com bubble. It is somewhat narrowed. There is, but that's a nod to the Forbes reporter in 1992 who was based in Houston, as I recall, who did that story.
Yeah.
But that story there was a chain reaction. About a month after that story, and I didn't know him at the time, a guy named Jim Chanos, someone faxed him the story.
Yep.
And he read it and did his work and then got short, as I recall, Enron, Dynegy, and Williams. And then he told another reporter about it at Fortune, and she wrote a report about it.
Bethany McLean, right?
Yeah, in, I think, February or March of 2001. The stock was already, I think, down to 60. It was close to, I don't remember what Dynegy's shares were at. I think Enron was just above 85, and the all-time high was around 90.
Yep.
When she wrote her piece, I think it was around the 60s, maybe low 60s. It had an impact.
Yeah.
And then but before that, Jim had given the name, as I recall, learning later. Jim had given the name at a conference he has for his friends in the short selling community, maybe a month or so before Bethany had done her piece. So he'd kind of I wouldn't call it public, but he had gone on the record with a group of friends, in a semi-public, I wouldn't call it a public forum, but in a small forum,
right?
Getting his marker down. And he was kind enough years later, 2002, when he got called under oath by the House Energy and Commerce Committee. They asked him to come testify, post-mortem about Enron and what he saw that others didn't. He was very kind, and his testimony to Cite, and we can look that up on the web, to cite that story, said that this is where we got the idea, reading Wall Street Journal, Texas Journal, Jonathan Weil, Energy Trader Cite Gains, but some math is missing. But there was, as I recall, there was somebody at that conference who was writing a newsletter named Mark Roberts, off Wall Street Consulting, who, after that conference, wrote his own very long-form report. Mm-hmm. And he was the first one to identify the related party transactions in the publication. I completely missed the related party transactions that were disclosed in the proxy, in part because I just missed the fact when they referred to Andrew Fastow as a senior Enron, executive. I missed it. Today I would never miss that.
Right.
And I'll tell you a story about Lehman where that was a lesson learned that came in handy. But anyway, after the point being that, just keeping the chronology going, after Mark's piece, and I don't remember if he quoted Mark, but Peter Evis, when he was at Street.com writing a column, getting in the summer now, he's at the Times nowadays. He wrote a piece about the related party transactions, and that was the first piece that anybody ever written about the related party transactions. But then also that spring, with hindsight, we know these things.
Yep.
As I recall, the regulators in California were finally figuring out how the rolling brownouts were happening, and they were getting a stop to them. And electricity prices were cracking, and people didn't necessarily know how these opaque numbers at Enron worked, but they knew that earnings went up and the stock went up when electricity prices and natural gas prices were soaring. And when they cracked, and they could see electricity prices were cracking, then the stock went down. By the time spring 2000 was happening, by the time we got into spring 2001, I should say, people could see electricity prices are cracking. The rolling brownouts seem to have figured those out, or at least cutting back the number of them. And what we didn't know or I wasn't aware of it until later at the Arthur Andersen trial, after Enron and Andersen had both failed, that there were these things called the Raptors. And I'll just try to boil this down at the risk of being simplistic. Once Enron's stock price fell below $60, they were going to be in a death spiral.
Yeah.
And so once they fell, because they had, and what we couldn't see, what I didn't know, what nobody knew until after the bankruptcy filing, was that they had taken on all this off-balance sheet debt. $10 billion doesn't sound a lot today when you're talking about, market caps in the trillions of tech stocks, but $10 billion of off-balance sheet debt. And Enron, I think the peak market cap there was $80 billion, but still the Babe Ruth of accounting scandals.
Right.
Once that stock fell below $60, it was going to be a death spiral because in part they were pledging their own unissued common shares as collateral for off-balance sheet debt through these crazy off-balance sheet transactions with their own senior executive officers who had stakes in those off-balance sheet partnerships that Enron was doing deals with. We didn't, but once you put it all together, it's like, why do the mark-to-market numbers matter? We really didn't even know the full scope of it until after the bankruptcy. Why did they needed the off-balance sheet debt? Because they weren't generating cash. They had to borrow. They couldn't show people what they were borrowing. That's how that they were funding themselves. Anyway, Skilling resigns in 2001 after being CEO for just like 6 months or so.
Mm-hmm.
He went on the record telling, I can't remember if it was our reporters or somebody else, he cited the stock price. I mean, who does that?
Yeah.
Ken Lay has to come back as CEO. And then one of the things I don't think people appreciate is the impact that 9/11 had on the whole chronology. But people were becoming aware, especially after the dot-com bust, that there were problems throughout the books of corporate America.
Yeah.
There had been plenty of scandals already, waste management, just to name one. When 9/11 happened, it was like, and then earnings season started the next month. And it was like one of the first stages of normality back in the capital markets again. It's time for, 3Q earnings calls. And earnings calls were kind of a new thing because Regulation Fair Disclosure had just come into play.
Yeah.
So there were earnings calls. And you could tell on the tone of the calls with some of these companies where the numbers were really controversial or becoming controversial, that on the buy side in particular, and even on the sell side to some degree, there was just a new impatience with anybody blowing smoke at them. If for at least a brief moment in time, the relationship between the street and management was, please don't sugarcoat anything. Tell me what's actually happening. And at the moment that people were, caught or known to be playing games, there just was no patience for it at that moment. That contributed a lot to Enron's failure. especially in October 2001, when my colleagues, John M. Schweiler and the late Rebecca Smith, they had a series of stories, 3 in particular, in 2001, where they really put a spotlight on those related party transactions, what we now know as like LJM, or the partnerships named after the Star Wars characters. They had gotten some of the actual documents, and then there was this mysterious $1.2 billion shareholder equity reduction that turned out it was just an error, but people really fixated on it because the company couldn't give a good explanation for what it was about, other than it had to do with Fastow and his crazy partnerships.
Right.
So, but though for a young reporter, I was 31 at the time when Enron collapsed, it was a very good lesson in watching how, with what ultimately was a financial services company, Enron, confidence can disappear in a moment, and when that happens, there's a run.
Yeah.
And that was not a too big to fail company.
Right.
There were some who tried to make it too big to fail, but it didn't work.
Yeah.
And once that confidence is destroyed, gone.
Yeah. Let me ask you this, and then we'll move on. Looking back on it now, do you think those guys, Skilling, Lay, the other people that were involved, were they victims? Were they kind of just victims of their own success, and they just believed the hype machine, or were they greedy bad dudes? Like, do you have a sense of that, or do you have an opinion about that?
I don't want to give opinions on it, but let me just give observations of what the news was
observations.
like at the time.
Yep. Mm-hmm.
I think people viewed Skilling and Fastow and Lay and others who went to jail through the same prism that they viewed Michael Milken and the Dennis Levine, Ivan Boesky, and the characters of the Wall Street scandals of the late 80s. It's like, these are corporate crooks. They make things worse for everybody. They don't get caught often. They don't get convicted often. But when they do, they go to jail, and that's the way it's supposed to work.
Okay.
That was the culture. The culture changed after 2008.
Yeah.
After 2008, nobody went to jail. No senior executive from any company that failed or got bailed out went to jail.
At least ones that people
I think there was one trader from Credit Suisse.
Yeah.
Who mismarked his book so he could get a higher bonus.
Right. But nobody knows who Taylor, Bean, and Whitaker were. Right.
I remember. And you remember.
Well, no, I do. But like regular people had never heard of TBW.
Right. And whatever the bank that was that it took down based in Montgomery, Alabama, nobody from
Colonial
there
or
went to jail
whoever.
Yeah.
Yep.
Nobody from there went to jail either.
Right.
Even though it actually failed and the FDIC sued the auditor and got a $500 million settlement.
Right.
So when nobody goes to jail after much bigger scandals occurred, 7-8 years later.
Yeah.
Then people start to ask questions like, well, is it fair that Jeff Skilling went to jail and nobody from Lehman Brothers did?
Right.
And I'll leave it to others to decide whether it's fair.
Yeah.
It's inconsistent.
Right.
Because with the likes of, and again, I'm just trying to be observational and just trying to be analytical here. I don't want to be engaging in opinion mongering. That's not my current job title.
That's right.
But when you look at the likes of Fannie and Freddie or Lehman Brothers,
yep,
or any financial institution that fails, usually it's because people look at the numbers on the balance sheet and realize these aren't the right numbers. Not only that, even dumb old me can look at these numbers and see these numbers are not right. If I know that these numbers are not right, everybody else knows these numbers are not right. I have to get out. And confidence goes.
Yep.
And the way confidence might stay is that you look at it and say, well, I know these numbers aren't right, and I know everybody else must know that these numbers aren't right. Well, I'm a bondholder, so the government's got my back if the bank or insurance company is big enough.
Right.
But I'm an equity holder. Now I own basically a call option or something.
Right.
But bailouts are not there for equity holders, generally speaking. Sometimes it works that way.
Yeah.
But what was so, I think, frustrating to a lot of people who thought they knew what the rules were post '08 is that that's why Fannie and Freddie and Lehman and others after them failed. That's why IndyMac failed before them. People could look at the numbers and say, there's no way that the management could be believing these numbers. So they run them, and then they wonder, well, I know that they put out numbers that were no good. Why didn't anybody go to jail? People used to go to jail for accounting fraud.
Mm-hmm.
If they put down numbers they didn't believe, we're supposed to have these certifications and all these different...
Yeah, this is in the post-SOX world.
Yeah, we're supposed to have all of these checks and balances and processes, and they still put numbers down that nobody believed and they couldn't have believed, and so why didn't anybody go to jail? And I think that's, I'm not going to say whether anything's fair, but
Right.
there's a consistency question.
Right.
And just from a policy standpoint, it looked like after '08 that there was a policy decision that we don't want to. It could cut a couple different ways. We don't want to do anything that would risk undermining confidence in the economy or America's financial institutions any worse than it already has.
Yep.
There are costs to that, like rule of law, and we'll eat those. Another view might be that, especially for anybody who ever read Hank Paulson, the former Treasury Secretary, his memoir that came out shortly after the financial crisis, it was pretty clear from reading his book that the senior management of Lehman was on the phone with him every day.
Mm-hmm.
So if you were going to go, and I'm sure it was the same thing at all the major banks, just deducing, it had to have been a Fannie and Freddie. So one might take the approach that, well, if they ever took a senior manager for Lehman Brothers and had a trial and put him on the stand, first thing that would happen is, well, before you put me on the stand, let's call Hank Paulson and ask Hank Paulson, did this senior executive or board member at Lehman tell you every day, what their financial position was like? You were on the phone with them every day. He said, we in this book, as I recall, they were getting regular updates of what was happening. So the defense, pretty good one, is that, well, our regulator and higher up in the government, they knew everything that was going on as it was happening. We were candid with them because we had to be. They demanded it.
Yep.
There were anecdotes that came out about how the government, whether from the Fed or other agencies, would call up bank CEOs and say, we don't want this disclosure coming out on this day, or we don't want this disclosure coming out on that day. So, there were a lot of complicating factors for why there were inconsistencies in the approach toward law enforcement from one era to another.
Yeah. So let's level set a little bit. By this time, because we're talking 07, 08, 09, you're not at the Journal anymore. And
right.
I know we're jumping over a lot. We're jumping over
So I left the Journal
and SOX, but yeah, so you end up, out of all places, you end up at Bloomberg, and then you do get to peddle some opinions for a while,
yes,
right?
I was an opinion columnist for 7 years for Bloomberg News.
And that must have been fun.
A lot of fun, especially the first 2 years. When I got there, I started doing that in 2007.
Right. So great timing.
Yeah.
Bit of luck. I mean, yeah, part of it's luck, right? It so happened, like current events happened when they happened, and you had the platform.
Well, to inform your perspective more about my perspective, with the exception of Bear Stearns, I had written about the accounting practices and questionable ones.
Yep.
Of just about every financial institution, that all the majors and Fannie and Freddie and others, brokers that went bust or needed a bailout or got had to get taken out in a take under. With the exception of Bear Stearns, I pretty much had hit them all on their accounting. So it wasn't look like you couldn't say that. Well, it's only with hindsight bias that someone might question their accounting. You had those issues then too,
right?
Particularly at Fannie and Freddie.
Yeah.
I remember at Freddie, the issue there was the same issue that Fannie and Freddie had years earlier during earlier scandals with cash flow hedges. I know that I'm really getting at your audience's hearts when I start to talk about cash flow hedges.
Yeah.
Freddie Mac was So cash flow hedges, you basically are doing derivatives contracts. And the thing you're hedging hasn't happened yet.
Mm-hmm.
You're hedging future transactions. In Freddie's case, they were hedging transactions that they were forecasting out 30 years.
Yeah.
And they told you this in the disclosures. And it reminded me of the conversations I had with Enron. And I framed the column this way, too. At that conversation with Richard Causey, the chief accounting officer, and 6 or 7 other people that Enron flew up before that story in 2000 ran, I let them have their say for a few hours and didn't really ask that many questions, except the most important, because we agreed about the numbers. They looked at my numbers. They said, your numbers are fine. It's all about how you interpret them. So I didn't really ask that many questions. That's all I really needed to know at that point. But I let them have their say and I wanted to hear them out. And then we got to the end, and I said, I got some questions. And it was very simple. I said, okay, so and this will tie back to Freddie in a second, I swear. But you have a long podcast, so I'm going to
Yeah, we do.
I'm going to avail myself of that.
It's okay.
So here's some questions I've got. So Enron's been doing the energy trading for how long? Well, we were the pioneers. I know, for how long? 9 years. 1991 we started. Okay, we were the pioneers. Yeah, I get that. Okay. And you're forecasting transactions, you're doing contracts and marking to market your contracts out 20, 25, 30 years. Yes, that's correct. And your experience in this business, which you're the pioneer, is 9 years.
9 years, yeah.
Okay, so based upon your 9 years of data, in which you're a pioneer, you're marking to model future cash flows going out 20, 25, 30 years. Yes. But, the average contract is 2 years. Okay, but some go out 20, 25, 30. Yeah. Okay. Were your models telling you last year that California electricity prices would be going berserk this year and we'd be having rolling brownouts? Well, this is one of those on a 100-year flood events. Who could have possibly foreseen that? There's, no, of course not. They weren't telling us that the electricity prices would be going berserk. Okay, fair enough. Who do you think is going to win? This is September 2000, 6 weeks before Election Day. Who do you think is going to win, Bush or Gore? Oh, the race is really tight. Polls are close. It's kind of hard to tell. Don't you think it matters a lot to your mathematical models? Oh, they're telling me, by the way, the people doing their mathematical models for the valuations, these were all like Caltech, MIT, Stanford, Harvard, wizards, physics, you name it, rocket scientists. Don't you think it would matter to your mathematical models if a Democrat environmentalist wins or if a Texas oil man wins? Well, yeah, I see your point. So the point being that I left the room that day just based upon those questions. It's like, if I think that they are doing the numbers in good faith, I don't know what basis they would have to do them.
Right.
Fast forward to 2008, when I'm calling Freddie. How can you forecast transactions 30 years into the future?
Right.
And then have hedges on them.
Yep.
And then lose money on the hedges hand over fist and use the cash flow designation to keep those losses out of net income and thus out of core capital, which is regulatory defined, or actually in their case it was congressionally defined. And they say, well, we know we're going to have to do the transactions. We know we're going to have to issue debt. I say, but you don't know the terms. And I'm reading right here in the standard, it says you have to know the terms of the transactions before you can designate something as a hedge for that transaction. Well, we stand by our accounting. Great. I stand by my column.
Yeah, right. So the other thing that I think that's important here is that you pointed out over many years, over many columns, that auditors were complicit in this accounting the whole time. And you had seen,
complicit's your word. I'm not in the opinion mongering business anymore.
Fine. But they
certified the financial statements. Yes.
Right.
They
right.
blessed the numbers.
They signed off on it. Right. Saying complicit was maybe a little bit loaded. I apologize.
I'm just trying to keep out of trouble, Caleb.
No, I know. And I am acknowledging that John is staying out of trouble and I am using the language that is maybe not Wall Street Journal approved. But you had the experience of seeing what had happened with Enron and Anderson, and not just Anderson and Enron, but Anderson and Waste Management and Anderson and WorldCom. You had seen how the role of auditors almost a decade before kind of essentially repeating itself in 07, 08, 09. And you had written at that time you didn't say, I mean, you had choice words for the audit firms during that time as well. It wasn't just the accounting. There were big prominent firms with reputations that were saying, no, this is fine. And so when you would write about them, like what were those conversations like?
Well, the auditors generally don't talk about their clients. So
Right.
there weren't many conversations. I'd always seek comment.
Yeah, right.
But two observations that I think are handy here. Before Enron, fortuitously, about a year before Enron, the SEC, when my old friend Lynn Turner was a chief accountant,
Yep.
came out with new rules that said you have to disclose auditor fees. And so we got starting in first half of 2001, the proxy statements came out. We started seeing all these different fees for audit fees and for non-audit fees. And I can remember really extreme examples like Raytheon, where Dennis Kozlowski was the chairman of the audit committee. You might remember him from Tyco.
Yep. Tyco guy. Yep.
Raytheon at the time was paying, like, I'm ballparking here, $1 million for the audit and $60 million for information technology consulting.
Right.
So, and there was a scandal for a couple years at that point. Well, look, the auditor's independence is compromised because look how much more they're getting paid for non-audit work versus audit work. And that's a good storyline. That's reasonable.
Yep.
After I sat through the Anderson trial for 2 months in Houston, they got indicted on a single count of obstruction of justice, convicted, thrown out on appeal at the Supreme Court, but the firm was dead by then. The brand name has been revived since. There might even be an IPO in the works with tax advisors and the like. But sitting through the 2 months of the Arthur Anderson trial, and I still remember, I think the audit fee was like, ballpark numbers again, $25 million a year, and the non-audit fee was $27 million. So based upon, well, the non-audit fee was more, that's, escandalo.
Yeah.
But when anybody who sat through the 2 months of that Arthur Anderson trial, I think, I'll just speak for myself, came away with the view, we had it wrong in that stereotype.
Yeah.
At least in the case of Anderson and Enron, it wasn't just non-audit fees that corrupted Anderson. It was any fees.
Right.
It was the sheer size, $52 million fee per year.
Yep.
It was the sheer size of the dollars. And we saw that with, there were emails that came out about like the engagement, the senior leaders and the engagement team and top folks would get together and have calls about, and they do this with every client. We just saw what they had for Enron. All right, do we want to continue to retain Enron as a client this year? Here are the positives, here are the negatives. There was nothing particularly distinct in that respect about Enron, except one of the things they noticed, well, they sure pay a lot in fees, is one of the things I remember.
Right.
So anyway, that kind of informed my thinking about, 8 years later, that I'm not just looking for, it really didn't matter if it was, in that instance at least, if it was non-audit fees or audit fees. I mean, there's the notion of auditor independence, there's a construct that the law requires investors to buy into.
Mm-hmm.
And that is that to believe that the audit firm is independent, you have to believe that audit fees have no impact.
Yeah. Or not a factor at all. Yeah.
So, and for a while that was I think there are still people who can say, well, it beats all the other systems. But that was revealing to me sitting through that trial. And then another point for anybody who was doing journalism or investing through that time period or was in the profession. When the government bailed out the largest audit clients of the big four accounting firms,
mm-hmm.
that also functioned, practically speaking, as a rescue of the accounting firms themselves.
Yeah.
Especially when the government refrained from bringing claims by the SEC or much less criminal cases where they alleged violations of GAAP. The scarcity of allegations of GAAP violations made it difficult for plaintiffs' law firms and others to be able to prove, scienter 10B cases because they couldn't piggyback on the government.
Right.
They couldn't piggyback on government evidence that came out in court proceedings. It's not that, if one were to think that, somebody printed bogus numbers on a balance sheet of a bank, one might think, well, there's probably some good evidence, that'd be interesting to review, that would explain why that happened. But when the government decided as a matter of policy that it wasn't going to bring those types of cases, well, there was no greater beneficiary, again, being observational.
Yeah.
There was no greater beneficiary than the major accounting firms.
Right. Yeah.
Because, what are you going to sue over?
Right.
To get past motion for summary judgment, if you're on the civil side, plaintiff's securities firm, you have to, you pretty much already have to have done discovery, but you're not allowed to do discovery until you get past the motion for summary judgment. Mm-hmm. So there you go. So
one other thing, I think, before we move on, another fun thing, and this is kind of how you and I don't remember how we first got acquainted, but one of the fun things, I'm going to probably talk about this in my introduction a little bit, but like you were one of the few people, the reason that you even got on my radar, late 2000s, was you were one of the few people that were writing about the accounting profession. You were writing about accounting, but you're also writing about accounting firms. You were one of the few people that were doing it with any kind of regularity. And that's how you got on my radar. It was like you and Floyd Norris. Like that was basically it, right? Like, or am I forgetting somebody?
No,
that
there
was
are
basically
others.
It.
Gretchen Morgensen would write periodically, and we had other people at the Journal who were covering the beat.
Yep. Yeah.
From 2000 to 2000 through the end of 2005, I was the accounting beat reporter for the Journal. I was a senior.
Yep.
We had more than one for a while. During the Enron, I think after the post collapse of Enron, we had like 50 people covering accounting stuff
right. Yep.
at any given time. You had 80% of telecom went bankrupt. 80% of energy trading went bankrupt. Arthur Andersen had concentrations in both of those. So all of our telecom reporters became accounting reporters, and all of our energy reporters became accounting reporters, and other sectors too. So, but yeah, that was my job. That was my beat, and
But as a columnist, mm-hmm. you and Floyd Norris were like the two people I just remember reading in the late 2000s more than anybody else. And then, Francine had the blog mm-hmm. world had been emerging by that point a little bit. And so that's when kind of Francine started writing more. Although that was, the blog, the legacy kind of writing, and then the blog writing, there was definitely a distinct world. And I was
terrific.
Definitely in the blog world. And,
she's terrific, and she's still at it.
Oh yeah, she is. Oh yeah. Yeah. And, so are you. So but you had this, the other thing that I wanted to mention before we move on is that you had and you just, you sent me an old column just a couple days ago, but you did this fun little thing. It comes through in your writing, because also if you have never read John's stuff, John is a good writer. He's fun to read. And I think that's part of the reason I took to you back in those days. And yes, I'm buttering you up, but I'm actually being truthful. Like, John's a great writer, but you kind of
Going Concern was the greatest publication ever.
Oh, now we know. I don't think anyone at the Journal signed off on that statement. So in terms of
I'm sorry, I expressed an opinion. But it was strictly an opinion about a journalistic enterprise. I should say it's second best to the Wall Street.
Second best, right. You're very.
I didn't want to engage in puffery there too much.
That's right. You're very kind. But one thing that I have to mention, I want to hear you talk about a little bit, was in the late, I guess it would be the late 2000s, early 2010s, you started kind of gleefully, because at this point, I'll just level set for the audience. It's a post Sarbanes-Oxley world. Mm-hmm. We have the PCAOB, which is the auditor of the auditors, to keep it very simple. And they would issue these reports they would select audits that were done by the big audit firms, and they would essentially give them grades, except they didn't give them grades. They wrote these long ass reports, but they never named, they never said who the businesses being audited were by the audit firm. And you didn't like that. You didn't like it one bit. And on a number of occasions, you were able to puzzle together who the businesses were. And the one that you sent me was specifically for Motorola. The auditor was KPMG and Motorola was the client. And through not only filings, but I think public statements and a couple other puzzle pieces, essentially by the process of elimination, you were able to figure out who it was. And you did that a number of times. And I'm just curious, how did that first, the idea to first do that, how did that like germinate? Did someone suggest to you, it's like, is there a way that you could puzzle this out? Or was it happenstance? I'm just curious how you stumbled onto that idea and how you kind of got to run with it.
I'll give you the medium length version.
Yeah, medium length is great. Yeah.
The very first time that the PCAOB put out inspection reports on the major accounting firms, I couldn't tell you offhand if it was 2002, 2003, but there was some little teeny tiny issue. Doug Carmichael was a chief auditor at the time.
Mm-hmm.
And it was some violation about lease accounting, and maybe there was an EITF pronouncement involved. But at that time, they used to note in a footnote on the inspection report for any firm where they looked at the inspection, if they found a violation of GAAP, they would give in the details of what the violation was. They would give the time period of what the violation was. And then often, if not regularly, in the footnote, they would say that this registrant, this company, restated its financial statements as a result of this finding. And so the very first time they did a release of inspections, some inspection reports on the Big Four, there was just one issue that they just hammered on. And then we let my colleague who was covering the accounting beat at the time, she and I went and pulled every restatement we could for that particular issue. And we had in the story, these are the first inspection reports they've done. The whole idea is to inform and protect investors. Here's what they found. We were able to go back and look and see, well, here are the 24 companies or whatever it were, and we listed them, who restated on this one little issue. And there's no way that they would have ever restated all at the same time if it hadn't been for the PCAOB and its inspection reports.
Right.
And we could piece that together. And the PCAOB was indifferent to whether we could piece that together. They're like, great. Use public information to go play detective and figure out who the companies were. It wasn't hard.
Right.
We're all for that. They had made a policy decision early on that they were not going to release the names of the companies where they found accounting errors doing their inspections. The law, on my read of it, and I think you've seen me quote the language enough times, it is within the discretion of the board to put whatever detail about a given inspection is necessary, in their judgment for the public to be able to understand what the findings were. Now, they took the position that initially they actually put this in writing that Sarbanes-Oxley expressly forbade them from naming names. And I would just, in those columns, just keep quoting the language of the statute that I think a plain reading, being observational here,
right.
is a plain reading would say that, no, it says it's in your discretion. So that means it's in your discretion. It means that there's not a prohibition.
Right.
Now, of course, the accounting firms and their clients would be very upset if they put the names in the inspection reports. From the standpoint of, imagine if you live in New York City and you where there's a very aggressive restaurant inspection team.
Mm-hmm.
Who'll go into every sushi. And every time you get a restaurant inspection in New York City, you can go look up the names of the restaurants and what they found.
Yep.
And if there are rats in the kitchen at the sushi bar on 58th and 4th or, whatever, you can put the name, with the findings.
Yep.
So my view on this, and then over time, they continued to put in, well, we found this. It had to do with this issue, at this issuer A, during this time frame, and here was the issue, and there'd be a footnote that, the issuer restated the financial statements. And sometimes if it was a company worth caring about, I'd do a column about it.
Mm-hmm.
And then ask the PCAOB, why don't you just put in the names of the companies? Because from the standpoint of that, a journalistic judgment here, investors, the public, would be interested in knowing that information because it's material.
Yes, that's right.
You have a de facto, a quasi-government agency, government for constitutional purposes, going in. They know about accounting violations, and thus audit violations that are material in nature at hundreds of companies, and they don't tell anybody what they were. I think just like any journalist covering the Pentagon or any other branch of government, you want to try to find out what government secrets are.
Right.
Because the public is interested in knowing what those are, especially if it's in with the government's discretion to disclose that information. That's just journalism 101. So that's why I kept on doing those columns.
Yeah.
The Motorola example, and I flagged it to you because I think it's just newly relevant.
Yeah.
Given what's happening with Congress and the PCOB right now. That was like the facts there were the wildest of any of the examples that I ever turned up. And I think I ended up getting like 7 or 8 columns along these lines over there. And sometimes they would come up because, well, they did the inspection of the Japanese audit of XYZ Big Four accounting firm. And they found violations of GAAP or IFRS or whatever at 2 issuers. Well, they only had 2 issuers as audit clients.
Yeah,
so you know
that's
exactly
right.
who they were.
Yeah, right.
There were a few like that in Bermuda, Japan, some of these other countries. There was often other countries where I'd be able to piece together examples like that. But the Motorola one stood out because it was such a big, it was a MicroStrategy type situation. I mean, I'm dating myself. I'm going back to like Michael Saylor MicroStrategy late 90s.
Yep.
Where they had, end of the quarter, they book a contract, they book revenue for a sale that happened like a few hours after the stroke of midnight at the end of the quarter. They put it in the prior quarter, and if they hadn't, dated it the way they did, they would have missed the badly.
Numbers. Yep.
And that's what, and the way this came out with Motorola, and this was all on the public record, and for the record, Motorola at the time said their accounting was fine.
Mm-hmm.
And I don't remember if KPMG had a comment, but they
I just read the column and they did not comment.
Okay.
Yeah.
So, in Motorola's self-defense, Motorola said everything was fine. The PCOB had said that there was a contract that didn't get inked until after the quarter closed by a few hours. Mm-hmm. And if they hadn't been, and then this came about because there was a class action lawsuit brought by investors against Motorola, KPMG, just all the usual defendants. And I don't even know how it turned out, but what was important to me was that there was a deposition that came out in discovery where the engagement partner for Motorola confirmed that issuer X, whatever one it was indeed Motorola.
Yeah.
Okay, we no longer can have disputes about we no longer have a mystery about who the mystery client was. Now we can go back and what was happening in that queue, in that quarter, what was happening, in that 10K. What can we look back on? How important was this? Did the PCOB know about this? And just as luck would have it, the chairman of the PCOB at the time, I think it was Jim Doty, had just given a speech anonymously describing how horrific this fact pattern was at this, at this company that had had the same auditor for 50 years, which matched the number of years that Motorola had been audited by KPMG. And, just again, I don't want us to get comical, but just being observational here and trying to lay the groundwork for what's there was just a House committee that voted by majority vote to eliminate the public company accounting oversight board. And I do think I have a hunch that if the board had been identifying the names of issuers all of these years, that more investors would have come to appreciate what they do, and rely upon them, and not want them to go away, because they consistently told investors valuable information about the financial reporting practices at the companies whose audits the board inspected.
Yeah.
And that's a policy decision they chose a long time ago. It's like the one place we don't get a look at their enforcement activities, because unlike enforcement activities of the SEC, all the proceedings are closed door until they're over with, which is a little unusual in American jurisprudence.
Right.
The auditing standards, they really haven't written very many over the years. They just took the AICPA standards and they've kind of stapled a couple here on, every now and then, but they really haven't done much. They've done some. I don't want to completely dismiss it.
Yeah.
But that's one area where I think if they had been a reliable, consistent source, just like restaurant inspectors,
Yep.
that there might be more people, just mom and pop everyday people who had heard of them before.
Yep.
And if not mom and pop people, institutional investors who would say, this is a valuable source of information for us.
Right.
There's a valuable check on them, just like, restaurant inspectors.
That's right. The grades hanging in the windows.
Yeah.
That's right. Yeah. We're going to come back to that we'll come back to current events in just a minute. But so I wanted to just quickly, you took a break from journalism, starting in about 2014. Is that right?
Yes.
Yeah. And you went and worked.
I went to work for Jim Chanos.
You went to work for Jim Chanos. That's right.
Kinnikos Associates.
Right.
As an
and
analyst.
So I know, we talked off the record a little bit, but you can't go into details about your work there. But broadly speaking, what this phase of your career,
we didn't talk off the record about that. I just told you I couldn't.
We didn't. Oh, yeah, you're right. You just told me. But I know you can't. I know you can't go into detail about it. But broadly speaking, that phase of your career, were you just kind of applying all this expertise and stuff that you were good at, just kind of it was a different application of that kind of work, right?
Well, yeah. I mean, I came in with one set of skills.
Yep.
And I left with more skills.
Okay, good.
I can talk a little bit, very broad strokes.
Yeah, of course, whatever you're comfortable
when I
with.
got there, Jim and the partners took the approach that, you were a journalist a long time. Now we're going to teach you to be a proper analyst. And so you're going to have to learn how to do everything that all the other analysts do, whether it's, building models or whatever.
Okay.
And so, it wasn't just, playing journalism at a hedge fund.
Okay. Yeah.
Yeah. And then there was another fund I was at for a year after that, Cardinal Investments, CPMG is also named, based in Dallas, but I stayed in Hoboken for that. And then, and I was there for a little while, and then journalism came calling back.
Yeah.
Or I came calling back to journalism.
So your experience in the hedge fund world, like you say, you became a proper analyst. Looking back on that, when you come back to journalism, what kind of tools or what makes looking at this stuff fresh? How do you look at things differently than you did before that experience?
I don't know that I look at things differently. It's just every experience that you have just, adds to your perspective and to your toolkit. Every year that goes by, you kind of can spot what's new and what's not.
Yeah.
The very first story, I don't know if you were going to bring this up, but I'll just as an example. The very first story that I did when I came back was about, November 22. I came back from my brief 17-year absence from the Journal.
Yeah.
It was November 22, and I had already had my eye on unrealized losses on bond holdings at all of the largest banks and regional banks in the country. And so the first week or two in November, as the 10Q data was rolling in, I had already been looking at the fair value footnotes for these companies, and ended up doing a story that three of them, the poster children we picked were Silicon Valley Bank, B of A, and Wells Fargo. And Silicon Valley Bank was the worst of all. And their unrealized losses on their debt securities, which in their case were mostly agency mortgage bonds, the fair losses on that exceeded their equity. Was anybody going to care?
Not good.
Yeah. And it was one of those things where, we didn't know we hadn't seen bank runs in so long. We didn't know there was going to be a bank run 4 months later.
Right.
Sometimes investors, can remain, willfully oblivious for a long time, and the stocks were down. depending on so it's kind of like with the Enron story in 2000, where again I was talking about we didn't have the language to describe then what we do that we do now. That story took me 3 months to do because 2 or 3 months, call it 2 months. It took 2 months to do because I was learning stuff from scratch.
Yep.
I was learning stuff about accounting, like, oh, well, when you change this liability or this asset, this is where it shows up in the cash flow statement if it's non-cash. Basic stuff. I was young. I wasn't. I was 5 years out of law school.
Right.
I was still
and you
learning
could ask,
a lot of basics.
You could ask the quote unquote dumb questions, and it was fine.
Well, I can still ask those.
Oh, good. People don't say, John, you should know. You should know that there's nothing to see here. I imagine you've heard that a lot over the years.
A few times, yeah. But so the difference between now and then is that story that I did then, I think I could probably have knocked it out in 2 days.
Yeah.
Because there's just the foundation is there.
Yep.
The analysis, once I saw for the first time, and kicking myself still, that in that first story in November 22 that we didn't put First Republic in, because I had the numbers on First Republic. I knew they were bad.
Yeah.
But, when you're writing for a broad audience, you start thinking in terms of, well, we're writing about, if First Republic, the unrealized losses were on loans and not bonds. So do I want to bring them in here? Because really I'm trying to make the broad macro point using the best examples. If I start talking about this one really great example, but it's about loans, am I going to muck things up?
Right.
So I left it out. Silly me. Should have done a completely separate story just about them.
Sure. Right.
Or should have done a completely separate story just about SVB and First Republic because they popped like nobody else.
Right.
But instead, First Republic became Silicon Valley Bank, or SVB, became one of the three poster children.
Yep.
And it was a B of A and Wells Fargo. The numbers were bad, but I mean, they're too big to fail. So
too big to
it's
fail.
A completely different analysis than SVB was.
Yep.
And I probably didn't weigh. I knew their deposits had shrunk a lot. I wasn't framing it in terms of deposit flight.
Yeah.
Because as a journalist, we're very conscious about the impact that our stories can have. We don't want to describe it as flight unless we really know it's flight.
Yeah.
In hindsight, we know it was flight. But the point being that when I was doing the initial analysis, the first time I saw the Silicon Valley footnotes for the 2Q number, I didn't need 2 months to get up to speed.
Right.
To know how to do that story.
Yeah.
And I had enough reps that I knew how to write that story simply.
Yep. Without
needing to hand-wring about it a long time. So that's where the getting old part comes in.
Yeah. It's there are upsides to it for sure.
Yeah.
So let me ask you this. I mean, this has been fun and great, and I love talking to you. What do you think? Just a couple things to wrap up. Like, what is it about? Oh well, first thing. What, when it comes to like corporate malfeasance, I'm not going to make you say fraud, but sometimes it's fraud. Sometimes it's just
what's the name of the show again?
Oh, my fraud. Yeah. The interpretation.
I wish you hadn't told me that. So.
Oh man, sorry. Anyway, got to do your diligence, John.
Yeah.
Like,
my bad.
You don't cover the media. You're not on the media beat. But no. Anyway,
I did write about Warner Brothers Discovery a few months ago.
Oh yeah, really? Oh man,
they have a lot of goodwill. I cracked a joke in the story that they also used to be the broadcaster of the Goodwill Games.
Oh my gosh!
So there are really good. I love a good accounting joke.
Yeah,
and, I got to make that accounting joke in an accounting story.
So it's Nebraska jokes and accounting jokes. I I don't think your Nebraska jokes make it into your stories, but that's okay.
Good time.
Yeah. Someday.
What? Maybe I'll get a Lincoln.
Yeah, there you go.
How is that for a pun?
Hey, man, God, you're on fire.
Smooth.
Okay. What is it about corporate malfeasance, financial reporting fraud, however you want to, all this stuff? What hasn't changed? What are the lessons we haven't learned, John? that are still coming up?
I don't know. There are lessons unlearned. There are no new stories. There are only new investors.
Right.
There are new, or another in the newsroom joke. It's there are no new reporters. There are no new stories. Only new reporters.
Yeah.
There's human nature,
Yeah.
and you can put her on any number of different guardrails or systems or controls. Fancy language like controls,
Yep.
and dress it up. But in the end, we have cycles of business. Even if governments want to try to occasionally outlaw them, we have booms and busts.
Yep.
Things come and go.
Yep.
Human nature generally doesn't change. We hope the world's leaders don't blow us up.
Right.
And before they do, things come and go, but people generally stay the same. And so you can't, there's the story is there are people who do good things and there are people who do good things, and there are good people who do bad things.
Yep.
And get caught. There are good people who do bad things and don't. There
Yep.
are bad people who do good things. And there are sometimes bad people who do good things and want everybody to know about the good things so that they won't look at the bad things. That's from Marianne Jennings, 7 Signs of Ethical Collapse.
Yeah, I was going to
One
say
of
that
her-
sounds like
her,
Sam. That sounds like Sam Antar.
Or Sam Bankman-Fried.
Or Sam Bankman-Fried. That's right.
Putting FTX's name on the Miami Heat's arena.
That's right. Yeah.
By the way, I would highly recommend to anybody that if you want to understand more about the way I look at these things, read Marianne Jennings' 7 Signs of Ethical Collapse. It is a wonderful. It's one of many fraud frameworks that I've read over the years, but it is a terrific one, and it's very simple. And you don't even need to read the book; you just need to read the 7 signs. Then
Yeah.
you'll want to read the book.
I'm jotting this down.
You should have her on your show if you haven't already.
Oh my God.
I've never spoken to her. I just am an admirer.
I mean,
But let's just read them aloud.
pressure to maintain numbers,
There you go.
fear and silence,
Culture of Fear and Silence.
culture of fear. Yeah, this seems to be
The shortened version.
a shortened version, but youngins and bigger than life CEO,
Mm-hmm.
weak board of directors,
Mm-hmm.
conflicts of interest overlooked or unaddressed, innovation like no other company,
Enron.
goodness in some areas atones for evil in others.
Stadium cursed charitable donations.
Yeah.
So, yeah, look for things like that. If you've got all of those things, I want to read your footnotes.
Yeah, no kidding. Okay. I guess then my final question is, are you, so with all that, the cycles and just different flavors of the same story, like, does anything surprise you these days?
Yes and no. I'm surprised every day by things.
Yeah.
But I think we've seen a lot in our lifetimes.
Yeah.
So does anything get my dander up anymore? I try to just be a spectator and enjoy chronicling the spectacle.
Yeah. That's a nice place to end it.
It's
Maybe.
yeah. Imagine if you're a journalist and you're assigned to go, cover the circus.
Yeah.
You go write about the circus. I guess you could say that for a while I joined the circus.
Yeah.
But then
Right.
then I jumped back out and started covering it again.
Is it more fun being on the outside?
I think they're both fun. I enjoyed doing what I was doing as an analyst. I mean, it's a quiet life. You're under fluorescent lights all day, reading 10Ks and 10Qs, and
Yep.
staring at your screens. I mean, we do travel and talk to people also.
Yeah.
But you're really tied.
You're not on deadline.
Well,
Ish.
depends.
Yeah, it depends. Okay, fair.
Depends what's happening in the markets.
Yep.
or how you're positioned. But, there are a lot of things you can do as a journalist you can't do if you're, working for an institutional investor.
Yeah.
Or if you're working, if you're actively managing anything.
Yep.
There are people you can't talk to. There are conversations you can't have with people even that you can talk to. You trying to stay as a journalist, you can call anybody, anytime, go anywhere, as long as they'll let you in.
Yeah. Right.
We just gather facts and print them.
Ask questions. Yeah.
Yeah. I would have never been able to come on your show when I was, working for one of those other places.
Right. Right. Let me ask. Oh, so I just thought of something else.
I love doing all of it.
Yeah. Let me ask you this. Do we need more people to do the kind of work that you do? Or do you like...
No, I want no competition.
That's right. You like...
Just tell them to stay away.
Yeah.
Go find other lives.
Right.
I don't...
Or maybe I'll phrase it differently. Like, is accounting still kind of this overlooked area where there are just oodles and oodles of stories to be told?
Well, interest, and again, I don't just write about accounting. There are
right,
other
of
stories.
course.
Yeah. I think every journalist, no matter what their beat, should take some time to learn the language of business.
Yeah.
I think any journalist in covering business should be able to read financial statements.
Yep.
I don't think there's a shortage of that at the Wall Street Journal.
Right.
There are other news organizations, and I'm not going to tout their horns, but there are other news organizations too where I don't think there's a shortage of those types of people.
Right.
At most news organizations, I think there is a shortage of those types of people.
Yeah.
So, but I would encourage, and anytime we have, anytime that I've gotten to know any of the young people here who come as fellows or interns,
mm-hmm.
I always, in some cases, I gave them copies of the book. I always tell them to go get a copy of Howard Schillett's Financial Shenanigans,
mm-hmm.
just as an intro to appreciate that this stuff can be fun. If you like covering car wrecks, if you like covering the police blotter, you'll love accounting.
Yeah.
It's just, if you like watching American Greed, you'll like watching, if you like watching professional wrestling, you'll love, learning about accounting.
Yeah.
How did they manage to, let me give you one other story. And there's another story that I tell people all the time, young reporters and old reporters too. Have you ever heard of a company called Max Internet Communications?
I don't think I have.
It was a Dallas-based company. The SEC called it a fraud. I wrote about it, I think, February 2000. One of my favorite accounting anecdotes. In the dot-com bubble, I think the market cap might have gone up to 800 million or so. It was big for the time for a
mm-hmm.
little Dallas company that just had little add-on cards that they would stick into computers to help with the sound system or something.
Yeah.
And their revenue over 3 quarters went from like $100,000 to $1 million to $10 million. And the accounts receivable went from $100,000 to $1 million to $10 million. And the cash went from $10 million to $1 million to $100,000. And 99% of the revenue was to this company that was their former Brazilian subsidiary. That's who the revenue was coming from. And you would ask the guy, I'd let him give a dog and pony show about their product for a couple hours.
Mm-hmm.
And
patient man.
Yeah. And, it was a great stereo system that they had that they, played for me. There was some Schwarzenegger movie they put on. I can't remember what. And I said, so where's the cash? And his Australian guy, I won't try to imitate his accent, but he said, well, it's a sore subject. It's in Brazil. We're trying to get it. Oh, okay. That's your on the record comment. The SEC pounced within a couple months after the story came out. It didn't trade for very long after the story came out. It was a Heard in Texas column, went to zero. It was one of those columns that my friend Larry Ingrassia is like, I've never heard of this company. Nice story, but I've never heard of this company.
Right.
Show me you can write a story about a company I've heard of. Well, again, I've never said who my friend in the investment management business was who gave me the idea to go, suggested I go look at Enron and Dynegy's financials and see how they make their earnings. But I got the idea for Max Internet Communication. I got the idea to go look at the energy company's earnings from the same person who suggested I go look at Max Internet Communications.
Yeah.
So the point being that when you get a good idea from a good source, whether that source is an insider or an outsider just making observations, you should probably do it.
Yeah.
Even if the company, as long as it's a good story, even if it's not the biggest story in the world, you should probably go do that story because you never know what it'll lead to.
That's right.
If I hadn't done the story about Max Internet Communications, which you'd never heard of before, that person probably would have said, "Oh, you know how to have fun with this type of stuff. Let me tell you about this other story over here that turned out to be pretty epic."
Yeah, big story.
So,
Well, thanks, John. I hope you had fun.
I had a lot of fun. Thank you for having me on.
Oh, yeah.
It's an honor. I appreciate it.
There you go. Jonathan Weil. Check out John's reporting in the Wall Street Journal. If you are a subscriber, their paywall is very rigid. It is impossible to get around. So if you're not a subscriber, you probably can't read John. But if you are, go read John. He's doing great work over there. You can still read his original report on Enron from September 20th, 2000. If you have a subscription, that link to that article is in the show notes if you would like to read that. And also the column that he and I discussed, identifying Motorola as one of the anonymous companies in that PCAOB inspection of KPMG. That column, he was in Bloomberg when he wrote that, but that's also in the show notes if you care to read that. And anyway, usually we talk about lessons learned here, but I think, we learned a lot listening to John, I think. But the one thing that I think that's been sticking in my brain since I talked to him was that the analogy or the comparison to like restaurant, health inspections, where if you're in New York or if you're in Los Angeles, and there's other places that do this, but every restaurant you go by, their health inspection grade is like right by the door. Like it has to be prominently displayed so that whether they, what grade they got on their health inspection. That is, the fact that you can do that for a restaurant makes a lot of sense. It doesn't make much sense if you can't do that for the audits that people invest in. If you can't get a grade on their audit, that seems kind of weird. I don't know, but that's what I've been thinking about. And anyway, that's it for this episode. And remember, you wouldn't like it if restaurant health inspections were on a pass-fail grading scale. So you shouldn't settle for audit inspections being pass-fail. If you want to drop us a line, send us an email at ohmyfraud@earmarkcpe.com or hit me up on LinkedIn. If you've got comments, questions, suggestions for a show, whatever. Oh My Fraud is created, written, produced, and hosted by me, Caleb Newquist. Zach Frank is my co-producer, audio engineer, and music supervisor. Laura Hobbs designed our logo. Rate, review, and subscribe to the show wherever you listen to podcasts. If you listen on Earmark, you can get CPE there. You can get a little CPE or you can get a lot. If you want a lot, you got to pay for it. Just know that, okay? Okay. Join us next time for more avarice, swindlers, and scams from stories that will make you say, "Oh my fraud."